Okay, well, as voluntary chair of this committee, I hereby call the Finance Committee to order at 4 p.m. on July 22nd. Need to do anything else?
No. And just for the record, the committee has selected Director Martinson as the committee chair. Have that on record.
Tall guy, blonde hair, very handsome.
Okay.
We need to call roll.
No, I would, if anyone was absent, I would state it for the record, but we're pretty informal in these particular settings.
You are okay.
Yeah.
Right. So I guess we should just start with you. You're gonna.
I'll actually start with a slight segue into this. So we're conducting the meeting of the Finance Committee, specifically with a presentation from PFM Asset Management. They are have been our assigned portfolio investment manager since 2019. As part of the budget conversation in reviewing our sort of anticipated interest return for next fiscal year on our investment accounts, we realized that that has been a decreasing number. And there are several factors because of that. And I think it brought to light sort of our need to have a better understanding of our current assets with PFM, and also how we're utilizing those assets for cash flow needs, et cetera, and how that's sort of impacting our return on our investments. Richard and I had a brief sort of conversation of how he got to this point and why he's presenting. And I gave him a couple of talking points that I sort of notated from our budget conversations. So hopefully some of those questions will naturally get answered in his presentation. But he's also here to answer any specific questions about types of investments, restrictions we may have as a government agency, you know, and then he can talk a little bit about sort of the history of our portfolio and sort of how it has changed over the course of the years and is a sort of a contributing factor to where we're at now. So Richard, I'm going to turn it over to you.
Thank you. Do you want me to share my screen?
I think we can bring up your PowerPoint if that's what you're going to use.
Yes, that's what I'm going to bring.
No, that's fine. I can do it.
Okay. Yeah. We're gonna bring it up really quick.
Sounds good.
Point of order here. The agenda says we should have asked if there was any public comment.
Okay, there is no public on, except for later.
But I will note that.
Yeah.
And as Allison was indicating, the real is to provide you with information and be able to answer you any questions. So if we go to the next slide, I think you can go to full screen too. Yes, perfect. Just to give you background, your objectives as any local agency in California are safety, liquidity, and yield in that order. Now, the government code doesn't specify what safety, liquidity, and yield mean for each public agency, so it's somewhat dependent to you. As far as where we are now, it's important to look at where we've come from, is that over the past few years, liquidity requirements have really driven investment requirements. As we'll see later, the size of the portfolio has decreased about 60% in the last 4 years. So again, the primary objective became we need to provide liquidity to the district to make sure that funds were available to fund project as needed. So that's somewhat different than when we originally started. The goal of the portfolio is more to grow its long-term value, and that liquidity needs were sort of met by current ongoing investment. Looking forward to where we go, and this is a good point to look at, we may not be at the peak of rates, but interest rates are still at good, attractive levels, is that we always want to remember that financial plans should drive investment plans. Ultimately, the district is not an investment program. You're a public agency. Your investments are there to support the objectives of the district. And as the next point, interest rates are down, but still well above their 20-year averages, and in a range of investment opportunities to exist. So as that is context, just to give you some background of the market environment, because that sort of drives a lot of the investment decisions. Let's go to the next slide.
I tried to change it.
Okay.
Hold on, we're working on it.
Sounds good. I won't read all of this. It's in the agenda package. Let's go to the next slide. The key driver of the investment advisor in the investment advisory environment has really been what the Fed's going to do. And it's been driven by inflation. So on this chart, we're showing you the two key measures of inflation. The darker blue line is core CPI. So this excludes food and energy. It looks at just the main products. And then the orange line is core PCE. This is the Fed's preferred measure of inflation. It's a little broader. It includes some things that are not in CPI and some other reasons that the Fed prefers it. But the key story is that it's still well above the Fed's 2% target. The PCE report comes out this Thursday. It's expected to come down a little bit more, but still above that 2% level. But given that it's coming down, the markets believe the Fed will be able to act it most likely at their September meeting. The markets are sort of pricing in 2.5 cuts this year. If we go to the next slide, the other component of what the Fed's mission is full employment. Upper left-hand corner is monthly jobs, and the last number in June came out at 206,000, very strong. Unemployment rate's been ticking up to 4.1%. That's a national level. The California level is 5.2, but still, from historical averages, it still remains fairly low. So this is something the Fed actually likes to see, and it sort of relates to the chart on the right, that this shows the number of jobs available per each unemployed person. After the pandemic, it became that there were almost more than two jobs available for every person unemployed, which meant that there was more demand for wages, wage increases, people were changing jobs. It created inflationary pressures, but now it's down to 1.22 jobs. And typically the Fed likes to see it at about 1, meaning there's one job available for each unemployed person. Doesn't mean that the job availables is what the person looking for a job is, but it generally indicates if the market's getting more in balance. If we go to the next slide, one slide back, one more. Perfect. This just briefly is the Fed's summary of economic projections from their last meeting to see where the Fed thinks happening by the end of the year. They expect the GDP for the entire year will come in at about 2.1%. The first quarter came in at 1.3. The second quarter, I've seen estimates from 1.9 to about 2.5. We'll see how that goes. Unemployment rate, they're suggesting that it would be about 4% of the year into the year. We're a little bit higher than that, but you actually see how they see it increasing in 2025 to 4.2. Inflation, that key measure, they're suggesting it'll end the year at 2.6, but not get down to that 2020 to their 2% level till 2026. So the chart on the right's the Fed funds rate. This sort of drives where interest rates will, especially on the short end of the yield curve, but the longer end also drives sort of inputs from this. So what we see is that they think that the Fed funds rate would end the year at 5.1, which would suggest only one cut by the end of the year, and that their longer range target is that Fed funds to settle in at about 2.8%, which is well above where it was in the financial crisis and the post-pandemic. Next slide. This is just to indicate sort of the history of what's been happening. The blue line is the 2-year Treasury, sort of the midpoint of where you can invest as a public agency. The red line is the 3-month Treasury, which is really indicative of what the Fed's doing. So now we see that the 2-year is bouncing up and down as the market tries to figure out what the Fed's doing. The red line, the 3-year Treasury, is still elevated because the Fed actually hasn't cut interest rates now. The other key point to see in this is that interest rates have come up significantly over the past couple of years, which is the same time that the district was facing significant liquidity challenges. So instead of being able to reinvest money as securities matured or be sold and reinvested, we mainly had to provide liquidity rather than reinvest. So the districts, to a certain degree, has missed out on this opportunity to reinvest at higher yields. That's why it's a good point now to look at where things are to say, well, what can we do now? Can we reinvest? The next slide is just the Treasury yield curve out to 30 years. The shaded area is the 1 year. The blue line is where it was of June. And then the dotted line was as of March. Again, to show you where interest rates, we have an inverted yield curve. Short-term rates are higher than longer-term rates. But if interest rates get cut, that short-term will come down faster than the longer-term rates. Rates have actually come down a little bit more since then because the market thinks the Fed will act. So that the 2-year, which was at 475 on this chart, is now at 452. The 10-year, which was on this chart at 440, was at 425 today. So rates have come down, but they're still elevated versus historical averages. So that's the market context. Interest rates are high, but expected to come down low, but not as low as they were following the pandemic. If we go to the next slide, we're showing a history of the overall balances. The lighter blue is the managed portfolio. These are individual securities that we bought. The blue is the camp pool, which is an overnight investment, liquid. You can move money in and out of it as quickly as you can. And then you can see the table in the below shows that how the balances change. So in June of 2021, the balance hit at 23.6 million total. By June of this year, it was at 9.3. Again, the reasons were driven significantly by the projects and needs of the district. So ultimately, the funds were being made available for what they were needed. But again, in that environment, you're not able to make a lot of new investments and take advantage of the higher yields. If we go to the next slide, just to show you a couple of comparisons last year to this year, upper left-hand corner, change in market value, managed portfolio, how much is in the managed portfolio, also how much is in the camp pool, that liquid, the average duration of the portfolio, the yield to maturity. Was there a question?
Nope.
Okay. The yield to maturity at cost is what the average yield of the securities were in the portfolio as of when you purchased them. Since market values have declined, the return on the portfolio is below that 1.2%. The yield to maturity at market indicates what your portfolio will yield from this point, June 30th, if everything was held to maturity, because all of those unrealized losses from higher interest rates, you won't realize them. You'll actually capture them back. So again, the average yield for the whole holding period will be about 1.2, but from this point on would be about 4.94. Next slide. This is just showing you a comparison of the individual sectors. So the top part is the managed portfolio. Over half the portfolio is in U.S. Treasuries. Again, being a public agency, we focus on safety and liquidity, which means U.S. Treasuries, but we add other securities when we can. You can see that the change from prior period is typically negative, and that reflects mainly the fact that we've had to sell, or things have matured since then to be used for the district cost. So again, some of the composition doesn't reflect necessarily what the strategy would have been if the liquidity needs haven't been there, but it reflects how we could best position the portfolio to provide what the liquidity needs were and minimize any realized losses. On the next page, I just wanted to quickly show you, we still remain very well diversified across a lot of investment types. Again, risk management is key, so we don't want to over allocate to any one particular type of investment. On the next slide is showing you earnings on the portfolio on an accrual basis. So this excludes any unrealized gains and losses. So you can see for the past year, the earnings were actually negative. We had to realize more losses to provide liquidity than it took in income. Past 3 months, that's changed. Over since inception, you can see that the portfolio, including everything, is still generated about 1.65 million in earnings. On the next slide, which will be my last slide of the presentation, this is showing you the return on a total return performance. So total return says not only how much did I receive in income, whether it's accrued or realized, but also what was the change in market values. So if I buy a security at a certain yield and interest rates rise, the market value that I hold in my portfolio has declined, because if I want to sell it, someone to get a higher yield will want a discount on the principal value. So total return includes that, whether or not it's been realized. So you can see that over the past 3 years, the change in market value given higher interest rates has been over $1 million. For the past 3 months in the past year, the appreciation, because interest rates have stabled and fall down a little bit, that they've actually seen positive market value appreciation. So the return for the past year on the portfolio has been 4.58%, including both income and change in market value. But you can see for the 3-year period, the return on the portfolio was only 4 basis points or 0.04% because there was so much market value depreciation because of rising interest rates. So in conclusion, interest rates are still relatively attractive, but they are expected to decline. The key driver of investment conditions over the past few years has been liquidity, not reinvestments. And then the real question for you now is, given where your financial needs are and the ability for new income to come in and everything else, where do you want to go from here? So hopefully that gave you a good overview.
Can you go back to page 10, I think it was?
This slide?
Yeah, so the 60% reduction isn't really lost so much in market value. It's just we took money out of the account to pay for things, right?
Absolutely. There was some slight change. Well, and over the past year, it actually appreciated in value, but there were some market value losses. But the bulk of this reflects money leaving the portfolio to pay for the district's needs.
So we're starting July 1st with basically 10 million, $9.5 million, $10 million in the account in various places.
Correct.
And if I go forward a couple of slides, you are projecting an interest rate for federal treasuries of 4.94.
Well, it's not. No, this isn't a projection. This is saying what this slide is showing you the return on your portfolio, including
Go
unrealized.
backwards.
Okay.
Go backwards. There's a slide somewhere that has a.
Yeah,
So what? One
Figure it out.
more, one more. Oh, this one? Not this one. Go forward. Are you talking? So what this is that
Portfolio overview shows.
So here's what I'm looking at. Right now, we just justified a rate increase to our consumers, our customers, based on a 1% projection of return on our investments. And that works out with $10 million, that's $100,000 a year. I think right now we have a limit of 15% in CDs. It's returning 5%, let's just say, which would be $75,000 a year. So we could make almost as much with 15% of our portfolio as we've projected with the entire portfolio. So, and what I relate that back to is the federal funds rate. We're projecting, at least for the rest of this year and next year, an average of, let's just say, 4.5%. So it seems to me that you ask where we want to go. What I would like to do, would hope we could do, is do better than an average of 1%. And ideally, if we've got over half of our money in treasuries, we're closer to that 4.5%. So do you think that's achievable?
that any new money, meaning if you put in a new money, not an existing security, it's easily achievable. Camp right now is at 544. LAIF is at 450. A 2-year treasury, assuming you want it long, is 452. So for any new money, that's easily achievable. The question is, with the existing funds in the portfolio, since they were bought when yields were lower, if I have to sell the existing securities, we can do, you would realize a loss. And I think it's about 450,000 realized loss. So you'd be coming out of a hole from that. And then you could reinvest and then you'd have to recoup. So yes, is it achievable with new money? Easily. The real question is new money available, or you will still have liquidity needs that will say, instead of putting additional money in the portfolio or making new investments, whatever they are in, that you still need to draw down on the portfolio, achieving over a 1% yield could be difficult. Was that responsive to your question?
It is and it isn't, because I've got more questions.
Absolutely.
If we've got we've taken money out of these treasuries to pay for projects. So presumably over the last few months anyway, we've taken a loss when we did that. And so taking money out, taking a loss is not something we've been particularly adverse to. So the question is, we take money out for now as we put it into projects. As you just said, we could sell those treasury notes or whatever that are earning 1%, turn them around and putting something into earning 4.5% or 5%. So the question is, where's the trade-off? If we put let's just say we take a 1% thing, sell it, turn it back into which is old money now, and put it back into a 5% treasury note. What's the time period necessary to achieve payout for that loss that we would incur?
I understand the question. We would need to do more analysis. The other question would have to be is, when will you need that investment? So what I don't want to do is buy another 5-year investment if you're going to need the money in 6 months. But you can look at, hey, what can I sell? What will the loss be? And what can it get on a new investment based on what your needs are for those funds in the future, and say, what's the best option? So that's something that we definitely could do, but it will be driven on when you need those funds. So again, we're not buying a 5-year security when you're going to need the money in a year.
I know what you're saying. And I'm again thinking, we put money in treasury notes, the idea that it would be liquid, but we still had to sell it at a loss because we needed it before it matured. So again, in this case, I think this committee's problem is, how much do we really need to have in something that's truly liquid? And by that, I would say, a 3-6 month treasury, maybe a 9-month even, but versus something that we could put into a longer term investment, knowing full well that we may, however unlikely that is, we may have to take it out at loss, just as we've done in the past. So anyway, is that something that's hard to do? Can you do that?
We can work on an analysis on that. I would talk to Allison to get some basic assumptions, how much it's going to reinvest in that type of thing. The other comment go ahead, Allison.
I think we've planned our next year's worth of disbursements. We know budget-wise how much we're going to need to disperse to actually supplement our cash flow for operational. So he has those numbers. It is no less than $200,000 a month, except for the month we pay our bond. I believe it's $800,000. So we have already pre-planned $3 million of disbursements over the next 12 months. And we have no excess cash flow slated to reinvest. So I can tell you that right now.
Other than perhaps the money coming in.
That will depend. I've said this a couple of times. That will depend on what increments that it comes in. So what will happen ultimately is that if it comes in small batches, it is likely that will just be part of cash flow needs. So in the event that it's sort of estimated cash flow needs, we won't essentially ask for more to be liquidated. If it comes in larger chunks, we'll definitely bring it to the board as far as what we plan to do with it. If it comes in small chunks, it won't benefit us to reinvest it, probably because they'll already be trying to liquidate something for pre-planned disbursements. So that will really depend. I'll have to talk to them. It'll really depend on what's coming in. I actually have
Generally, we could assume that would be new money.
Well, it is new money, but it may be new money that's not available for reinvestment. It may be needed for cash flow, depending on what time of year it comes in.
Cash flow budgeted right now without it. So presumably we're covered.
That's not how that works, though. The money for our budget does not just come from the bank account. It comes from various sources that total this, and $3 million of it comes from this investment fund.
Okay. Yeah. Anyway, I think you get the idea of what I'm looking for. I don't like us earning 1%.
No, I agree.
That even if we had to take a penalty to get higher interest, it would be worth doing potentially, depending on where that trade-off is. If it's it's a 5-year payout, then that doesn't make any sense. If it's a 3-month payout, then that makes sense.
And we can take a look at that and say, based on this, what it makes sense or whether it not. The one thing that I would say is, given that the yield curve is still inverted, when you do have liquid cash, you're still earning a nice attractive. So if you put it in the camp pool, it's earning 544. And even if you put it in LAIF, you're earning over 450 right now. So if you get in additional funds until they're needed, you don't need to reinvest them in a security. You can put them either in camp and LAIF and at least earn more than you are on the managed portfolio right now.
So I guess my general question, in your view, would it be safe for us to assume that our return on our investment portfolio will be greater than 1% over the next year?
Based on everything I know, that should be achievable in total.
And that didn't tie it to how much. That's the next question. Are we going to be
How
at
much?
3%?
I would need to look at the numbers a little more.
Yeah.
So
Okay. Well, you get what I'm after, I think.
I think
Can
so,
you-
yeah.
It's another slide I had a question about. If you could slowly go down and let me find one. There was one that didn't make sense because the numbers didn't match. I think forward. Go, yeah, keep going. It was a bar chart. I remember that. Not that, keep going. That chart.
There's a good one.
Okay, so that chart I had a question on. And it's probably just me not understanding it, but when I look at that, I see that the blue bar is our funds as of June 30th. Is that
This year.
When I add up the blue bars, I get something like 15 million, not 10 million. So what is the difference?
It would be an error on my part.
You see what I'm looking at?
I see exactly what you're saying, because if I add just the 4.1 and the 10.1, we're over 9.5. So that is an error on my part. I'd have to look at it again.
You don't think, and it's not just inverted. I was thinking maybe the gray was really the blue, and but that's over 10 also. So.
No, it's, I need to, there is obviously an error in it that I've made.
Okay.
I'd hate to speculate on what the error is without looking at the numbers, because I could give you a different error.
All those,
Apologize for
all
that.
those dollar values in the bar charts are yield market. We yield to maturity, not we sold it right now.
Those are the market value. So that's the value you would get if you sold it as of June 30th.
Okay. Okay. I'm sorry, Chair.
It doesn't say how much we paid for them, but that's what they would be valued at if we sold it.
If we sold everything today, yeah,
Then
the market value is 9.5.
yeah. So you see why the number doesn't.
Sure. Isn't the blue representing June 30th of 23?
No, it's supposed to be June 30th of 24.
24.
I think it represents 23. is what the
It's
problem is.
possible. Again, without looking at the
Gray
thing,
is 20, the blue is 24.
Well, but if you look,
That still doesn't add up.
there's an
Well, doesn't-
error on my part. I'd have to look at it. I can look at that and get back to Allison.
It's not an obvious error. It's a complicated one to figure out. Okay, that was a question I had. And then is there, I think we've touched on this. I don't know really what I'm asking, but is there what I asked you is, do you think it's likely we could do better than 1% on our current portfolio? And the answer was yes. How much better? That's a question. But is there any way to show current investment rates on our portfolio right now? In other words, we have so many $1 million in this, and that's returning an average of this, or, and here's another bit of money that we have that's returning an average of that. So I have kind of an idea of what a mix of the returns are. You gave a slide that showed the mix of investments.
That's the next chart, Tim.
Is it the next chart? Well, maybe next chart. That's not a chart.
No, again, that one,
Oh, that is, okay.
in the agenda package on page 49, there's a listing of all of the securities in the portfolio as of June 30th, 2024. It's grouped by individual security and security type. So for example, the average yield of all the US treasuries in the treasuries in the portfolio is just under 1%. The returns on the municipal securities in the portfolio, the yield on them, it's 1.33. And then federal agencies are 0.5%. And then the corporate securities are 1.71. The agency securities are 3.15. So it gives the yields, not the return, but the yield on all the securities by their individual investments and by the sector grouping.
Okay, well,
That starts- that-
word packet.
No, that's in this packet. It's on,
It's on page
it's on
49.
49.
So that's the crux of my concern is we've got a bunch of stuff that's doing less than 2% at a time when interest rates returns are typically closer to 5. It just seems we ought to be able to get rid of that junk and reinvest it. If there's a way to do that and have it make sense.
And there is, it becomes a matter of one, to make sure that we don't invest too long and it's consistent with the other plans. In context, when we typically manage a portfolio, when the portfolio is staying the same size or growing, we'll continually make small trades like that. We'll sell something, buy something at a new yield, sell something, buy something at a new yield. So the portfolio will naturally adjust over time to wherever current interest rate levels. But again, since we were taking money out of the portfolio to provide what the district needed, which is ultimately the purpose of the funds,
That's why
we weren't making new investments.
Well, we could have been.
We could have been, again, but liquidity was a primary.
We didn't have a demand for all 20 some odd million. We had a demand for 7 million. So we had 8, 9, 10 million that we could have been reinvesting without necessarily worrying about short-term liquidity.
That's true.
So that's just where this is what flashed in my mind when I saw our budget, that 1% right now is ridiculous. We ought to be able to do better, but I understand the penalty issues and all that. So if there's a way to look into that, maybe come back to the committee with an idea of what we might do to even double interest rate. Hopefully better than that. I would be interested in that. I don't know if anybody else is, but I certainly would be.
We can definitely look at that and at least give you some more numerical estimates. Again, it'll have some assumptions in it, but at least give you an idea of, in general, what does it mean? And then you say, yes, it makes sense, or no, it doesn't make sense.
Yeah, because I don't want to jeopardize the security issue. I also don't want to feel like we have to maintain 100% liquidity when we really don't. We've shown we're not adverse to taking a penalty by selling securities. But in one case, it makes sense because we needed the money to invest in projects and repairs and whatever. This, it might make sense just because we want to take a short-term loss for a longer-term gain. So anyway, I think you understand what
I do.
Seeing and wondering about. Okay, what other question did I have? I had some other question. Oh, I had an odd question just about the particular security. I noted we had John Deere in there. News I'm seeing is they're doing layoffs and they're not doing very well. So again, I'd rather have that in a 3-month CD than have it in John Deere. But those are the kind of questions that if I were deeply involved in this, I would wonder about. The same with that RMAX thing. We're just buying used car loans, and I don't see that makes a lot of sense either right now. But and that totaled like 0.7% of the portfolio. It wasn't very much, but it struck me that there's some things in there that aren't necessarily where I'd want money, even though it's small dollars in total. You don't have to answer. Just be aware that I'm looking at it.
No, and that's good. Just for context, we have clients, because like I say, the government code says safety is your primary objective, but doesn't define what safety is. So I have clients who said safety means I don't buy anything other than a US Treasury or a federal agency. I have other clients who say, as long as it's permitted by the California Government Code and you've done your credit research on an ongoing basis, which we do, they say buy anything allowed by code. So we would believe those investments in the portfolio, even the ones you called out, represent very, very low chance of a default or anything else. And that's one, but again, it doesn't mean it's perfectly safe versus a treasury. And that's one reason we keep the percentages low. But knowing that you have concerns about like that would influence us, because ultimately you're the individuals responsible for the district's money. So it's important for us to hear those things.
Well, again, it's a relative thing. You know, if you see in the news, a company's shrinking, like John Deere appears to be, versus putting it in a 4 or 5% treasury, I know where I would put my money, and I don't know how quickly you can get out of it, assuming it's stock, but.
It's not stock. It's all of your investments are fixed income bonds.
Fixed income bonds, okay.
Yeah.
That
And you're not allowed to buy equities.
And that explains the University of California or UCLA stuff, right? Because is that a bond that
That would have been a bond they had issued. Cal
Created
State
for
University, yeah.
for creating buildings or something or whatever they were doing? So,
They issued
okay.
revenue bonds to fund some project, and then we bought a portion of those.
How about CarMax? What is that?
These are asset-backed securities. So what they are is that they are a pool of loans that underlie these, that you get a proportional share based on what a certain criteria of interest and principal each time it pays down. Now, a key aspect of these is that asset-backed securities, you have to do the credit research to understand what type of loan you're actually buying. Where people got into problems during the financial crisis is they bought things simply because it was well rated without doing research on what type of loans were they subprime or prime loans. None of these are subprime. These are all top quality FICO scores. And then also what other protections in it, because even in a perfect world, even if I had a perfect credit score, there are people who lose their jobs, have health problems, and they may not be able to pay their car loan. So it assumes that there'll be a certain amount of defaults in this that are covered by collateral in the pool and other parameters. So we carefully monitor each month to say, how well is the collateral pool performing relative to what the assumptions were? And the idea would be is if we started to see it turning in an adverse manner, we would exit this. And these are the types of structures that we sort of went back. Again, these aren't loans that were outstanding during the financial crisis, but similar loans were. And we look at, well, how did these types of loans perform in a worse scenario or during the pandemic? And will you as an investor still pay your principal and interest when due? And the story was, yes, they did, because of the structures that we typed to buy. And again, ultimately, there's no guarantee. So we keep the amount allocated in any one name to be very small percentage of the overall portfolio. In the unlikely but non-zero event that something could happen that we didn't anticipate or evaluate.
Okay. Well, I think those are my questions. I don't know. Go.
Thank you. Yeah. I noticed in the charts we looked at a little before, there was a pie chart and then some bars next to it. There's one. Okay. That says if we sold the entire portfolio tomorrow, we would get about a 1.2% return.
It would
That's
say,
correct.
what it would say is the yield on those securities that you purchased, if held to maturity over the entire time period they were held, you would earn 1.2% in total return. The yield to maturity at market, the 4.94, says given that some of these have unrealized losses, if we held them to maturity and that unrealized loss was not realized, the average yield on the portfolio from this point in time would be 4.94% on a total return basis.
The 4.94% based on the now lower value of the portfolio, right?
Exactly. So if I don't know the exact number, but let's just for assumption, let's say that the return on the portfolio of these same securities from when they were bought to June 30th was negative 1.9%, making up a number. I don't know the real number. If I held them to maturity to get it to average to 1.2% over the whole holding period of each of the securities, I'm going to get now 4.94%. So if I, from the minute I bought it to the minute I held, I'm going to get 1.2% on average. But given those unrealized losses, if I held it from now to maturity to make it average that 1.2, I'm going to get 4.94. Is that responsive?
I'm not really understanding, I guess. The yield to maturity market says if I bought all this stuff today and held it to maturity, I'd make 4.94%. I don't see the relevance of that number because we already own all that stuff.
Well, what it says in one sense that if I sold everything, and again, this isn't what you would get, but say if I sold these exact securities and the most I could make is 3% from now until the same maturities, it would say I would never recoup my loss. If I can sell it and that I can earn 5.25% for the same securities to what their maturities are, I would net be better off. What this is telling me is that in your portfolio, there are certain securities that you would be better off holding to maturity, but there will probably be certain securities that it would be better off to sell now and reinvest at a higher yield, and that you'd be able to recoup your loss. The yield to maturity market sort of helps a portfolio manager to say, what will this return on a total return basis from this point in time versus what are the other options in the universe? So if I can sell it and earn more than that, I would be better off selling it.
In other words, don't hang on to something that's not, take the loss, reinvest it, do better.
But neither one of those lines, either YTM cost or RTM market, says that, at least as I understand it. What I'm interested in as an investor or on behalf of the district as an investor is where's the best place to have the money that I have right now invested? And both of those lines talk about the yield if I hold everything that I have, not if I sell some part of what I have and reinvest that money in something else. And so I'm not sure of the relevance of either of those lines.
So I think I'll answer what I think, and that way you can answer what you know, because that way will help clarify. But what I see is line on the 1.2%. That's in effect old money.
It's all old money. It's just counting from a different starting.
So the point is to make it new money to get the 4.94, you've got to sell it.
No, the 4.94 is how much I'll make at maturity if I assume that what I own today is what I really paid for it.
Well, I think what he's saying is correct. If you sell it, reinvest today as new money, then you get the 4.94. If you keep it, you get a lower interest rate.
It's sort of
those things
both of those items.
2%. They're not.
I'm not questioning I'm sure that whatever these things were when they were bought, we being us and PFM, doing the best we could to get the best yield we could. But I guess I still don't understand yield to maturity market. That says starting with, if we assume that today's value is our cost basis, which is wrong because the market, the portfolio is down, then from here to maturity, of course, it's going to be better. But how relevant is that? The cost basis is really on that cost line. And the market line, I think, assumes that today's market value is our cost basis. Since the market's down, yes, at maturity, we're going to get a better yield. But my question is, with the money that we have, the 9.5 million, where's the best place to put it? I was looking at Treasury I-Series bills and bills today, and they are currently in this 6-month period, they are yielding 4.28%. If we sold everything, we sold the 9.5 million, or we sold everything in the portfolio whose current yield is less than 4.28% and invested it in Treasury I-Series, is there anything illegal in doing that? And what it seems to me pretty straightforward that our yield will be better.
Well, absent, there'll be a penalty for selling it before it matures. And
Well,
so,
yeah, the penalty is that you have to sell at a price that yields the current return. I agree. But
it'll be
aren't we already talking about that?
1.2 or less, and then you reinvest. So the penalty, if you buy a treasury, let's say $1 million, you're going to need to help us with this, but let's say you buy something at $1 million. That's a 2% return over 5 years. Okay, so if I sell it after 2 years, I may be able to sell that $2 million only for 1.7 million.
Depends on where interest rates went in the
Exactly.
meantime.
There'll be some penalty, some discount. So,
Oh, actually, you might get more.
but not right now, you wouldn't.
No.
So let's say I sell it at 1.7. So now I've got that 1.7 and I reinvest that at 4.3, 4.28. So now the question is, how long does it take me to pay off what I lost in selling it prematurely
Sure.
and the amount of interest I would have gotten if I held it to maturity?
And
So that difference is what makes it worthwhile or not worthwhile selling stuff early.
And that is absolutely true in a time when interest rates are going up. You're going to pay a penalty for selling early.
Right.
Right now, interest rates are coming down.
Not very fast, but they
Not
are.
very fast,
They are coming down.
but they are not going up. And when I looked at, there's a chart not in this first briefing, but in the board packet, well, in the second piece of it that has a lot of the same charts repeated, but has other charts as well. There are a lot of treasuries that we hold right now that are paying less than the current rate on Treasury I-Series. And one of the questions that I put up was, is there a legal cap on how much we can invest in treasury bills and bonds? And according to page 18, this, I don't know which, this is 18 in our packet, not on your chart numbers. The answer is we could put it all there if we wanted to. The legal limit is 100%.
Well, I know we've got certain guidelines within the district as to what we can do and not do with the money. I'm not that familiar with
We're
those.
not officially here, or we have a quorum
You have to
in the
be.
committee.
No, I'm in the committee, am I?
The next one.
You're in the personnel committee.
Oh, you guys are sorry.
This is the finance committee.
Allowed to participate, put it in Brown, I can put it.
It can be public, you know.
Anyway, so, but as far as interest rates declining, that's the point of buying them now. You can trade out your low interest rate. buy
Exactly.
higher interest, because if you buy a 9-month or a year or a 2-year one, that's fixed for the next 2 years, regardless of whether interest rates.
Actually, the I-Series, the yield changes every 6 months. But currently, Currently,
Maybe you'd rather have something that's fixed.
the I-Series, it has a fixed portion and a variable portion.
Okay.
Right now, the fixed portion is 1.3%. The variable portion is just under 3%. So the total yield for this next six-month period is 4.28, which starts to get us toward that 4.94, if that's a real number, except I would contend it's not.
I think
I just can't figure out
it
why
changes.
why we are holding, whether it's treasuries or other investments, why we are holding those whose yields are so low.
I think that's because that's what we instructed him to do.
We instructed him to buy low yield investments and hold them.
When you bought it, you thought you were doing the best you could do. Nobody predicted we were going to go
Back in the day.
So we've got stuff that has 1, 2, 5-year maturities that we're holding, but now interest rates are significantly higher than.
Right.
So the question is
So what's the best
wanna
thing
sell
to
it?
do with the
Exactly.
money
What do
that
you
we
wanna do?
have?
now, and that's what we asked him. What can we do in light of the penalties and whatever, the payout period to sell something and buy something better and net higher result, a higher income, over some period of time, whether that's a year, 6 months, 2 years, whatever it would be. But we have no way within this committee of knowing that, how that math would work out. I
No,
think
because
only he,
he's got to run
and so that's
a
what we,
bunch of numbers to get that answer.
if that's something he could do and come back to the committee and however long it takes to do that, then we'd have a much better idea, because as he said, we kind of set the guidelines around how much liquidity we want. Sure. How much security we want. We probably have rules and regulations within the district of how much can be allocated. For instance, I know CDs is 15%. That's all we can put in CDs. But, they're earning 5% right now too. So anyway, it just seems that we have the fundamental same question. Why are we keeping low yield stuff? We could potentially have it in high yield stuff.
It's low yield right now because interest rates are up, but the yield is what it is. If we sold it today, and if we sold it and got a yield of, I don't know what to do with either of those two yield to maturity numbers. Let's just say the yield is 1%. If we have asset, whose current yield is 1% if we sell it, and we sell it and we buy treasuries that are paying 4.5%, why would we not do that? That's fundamentally what I don't understand.
That's the question we've asked of him to tell us fundamentally, why would we or why would we not do that?
If the yield right now is negative, then we need to think about that. But still, if the yield is less than what we could get with the underlying asset, if we invested it today, why would we not do that? I did have another question, and this is detailed with your assumptions. I said it's page 18, so I'm not sure what the number is, because the charts show a number at the bottom center of the page that is different from his numbers.
Number 13.
18 would be maybe 13.
This one.
Yeah, this one, we got it. We got it up.
Okay, all right. What is, you've got a measure of the portfolio against a benchmark, which was identified as the ICE Bank of America 1 to 5 year U.S. Treasury Index. Could you explain what that is?
Yes, definitely. So at the beginning of the engagement, based on risk return preferences, a benchmark was selected, a total return benchmark was selected to say, how do we compare relative to this over longer terms? Based on history, we can sort of say this benchmark will drive this kind of earnings in these kind of conditions. So it was meant to be an objective standard, not calculated by us, but calculated independent, that you could compare on a total return basis a benchmark measure. Now, the difficulty is we haven't been able to manage it consistent with the benchmark. We've been managing it based on liquidity. It's important to note that these are total returns, so the return numbers include the change in value, whether it's realized and unrealized, in addition to just the yield you're getting on it. Did that answer your question?
I understand the constraints you have trying to provide the liquidity that the district needs.
Yes.
Yes. As the requirements for liquidity arise, I'm curious, just in general, how you decide what to liquidate to provide that liquidity.
There are two aspects. So one is, are there maturities in the portfolio that will roughly align with when the funds are needed? So for example, in the most recent 3-month period ending in June, most of the liquidity was made available from maturing securities. Since that wasn't sufficient to meet the full need, we looked at the other securities and says, which security can we sell that will realize the least loss to the district? So again, we want to minimize realized losses, then we'll sell that. And then also, we're not going to sell a $5 million security if you only need $1 million. So it's based on those types of factors. How much do you need? What's going to get you there with realizing the least loss?
Realizing the least loss means that you're preferentially liquidate the assets that have higher returns rather than get rid of the ones that have lower returns. Is that generally true? You retain the ones that have lower returns?
And it would also relate to how far that security has to mature. There are other factors, but that would have an impact. A higher yielding security would most likely have a lower realized loss relative to other securities. There are other factors, but that is a key factor. You were correct.
Okay.
But
It sounds to me like we're hanging on to the low yield stuff, the long term, and we're selling off the high yield stuff for liquidity. Did I get that right, or did I misunderstand?
There's some impact of that, yes. It's not entirely that, but it's a significant portion of that. That would be correct.
it would seem to me it would also depend on how much time remains to maturity.
Correct.
Since if you had a high yield instrument and low yield one, and let's say they're each $2 million, we need $2 million to fund a project. I would sell the low yield one, the high yield one, but that could invert depending if the high yield has 3 more years to run or 6 months more to run versus, so I think it could be either way depending on time remaining to the full maturity. But anyway, it would make sense to me that you keep your high yield stuff and get rid of your low yield stuff generally.
As we go into the second part of the packet here, managed account detail of securities held, there are a large number of treasury notes that we are holding right now yield 1% or less. And I'm just trying to understand why we're holding them.
I am too, and I think that's the question we've asked him.
Okay.
What can we do with those to get our?
1/4%, 3/8%, 3/4%. There's only one on this page that yields more than 2%, more than 1%. And I don't understand why we hold them. They're all treasury notes. They all have the same level of safety, and current treasury notes are paying 4 or 5%.
Yeah, so we need to adjust our.
I just need to understand why we're doing what we're doing.
Yeah, and the decision, if I sell it, I'm going to have to realize a loss that I'm going to have to recoup with the new investment. And if I don't earn enough on that new investment to recoup that loss plus earn more interest, then I would have been better off holding that security. And that's what that yield to maturity at market indicates, is if I hold them into maturity based on where the current loss is, I can earn, I think the number was 494. I would earn that. So if I don't earn more than 494, I'm not going to even recoup my loss I took to make that sale. But
So-
you've got the exact question is we need to look at each of these based on where your liquidity needs are and what you want to do and say, if I sell these securities, can I more than recoup the loss I'm going to take upon sale and be net better off than I would have been?
Yeah.
I think that's the question we're asking of you to think you've got. What I'm wondering, as a matter of general practice, when interest rates jump like this, when do you normally respond to it? I mean, it's been a year since it's been like this and we're just now thinking about doing something different. So is that a normal time period for big agencies to kind of, so to speak, sit on their thumbs for a while until they're sure what's going on, or because of security issues, or?
I've had a range of it. I would say that I should have followed up with this with Allison sooner. Again, I think I was distracted by liquidity needs, but that didn't mean there weren't other opportunities to this. I have other clients who say, I will hold everything to maturity. I don't want to realize a single dollar to a dollar of loss. So they say just sit on it until the end. So it's not, there isn't one way to do it. But going to your point, it might have been something that a year ago I should have been talking to Allison about.
Maybe 4 months ago anyway, but not.
A year ago, definitely.
Well, we're where we are, so let's
Thank you.
proceed with that. Do we need
Yep.
to,
No, I think the direction that we have is that Richard will work with me. We'll talk about liquidity needs so he can have those numbers as anticipated considerations. And then he'll will reconvene at another committee to talk about potential reinvestment plans for things that may have a higher yield. You know, as after he evaluates potential losses and see if we can get a greater return on our investments with considering any liquidity needs going forward. That sounds like the summary of what I'll be working with him on.
that's a good summary.
Okay, perfect. So Richard, I'll touch base with you and get you some numbers based on, you know, what we've budgeted. And then you'll have something to go on and we can plan and see what's a mutually available time to reconvene with this committee.
That sounds good. Thank you very much, Allison.
Perfect.
Thank you, committee.
Thank you for your time.
Very much. That was very instructive.
Good. Well, have a good day. I look forward to talking to you soon.
Thank you.
Okay, so